Okay, you guys, sorry, I was trying to straighten out my paper. Okay, so we've got these consolidation entries that are not done on either Company A or Company B's books. It's done on a separate consolidation laptop. It's a consolidation working paper. So we did the entries. You've already posted them in. Notice you had to add contract goodwill. Okay, now just in case you can't remember how to go across a worksheet. And before I do, you guys, beware. Sometimes they will give you the December 31st balance sheet. Now, if they did, if this says December 31st, would the cash payment have come out already? No. Okay? So, December 31st balance sheet, we would have to take out the $95,000 and the $2,000 in legal expenses. Okay? And down here, the parents' retained earnings, we'd have to take out the $2,000. Okay? So if they gave you December 1st balance sheet. Okay? So just watch for that, because again, that's what they expect you to notice it and go, ooh, the entry isn't done. This first entry, oh, hang on, let me grab it on page 6. This first entry isn't done yet. Okay? We better take it out. But I want something. If there's already an investment in B Corp, does it mean the acquisition entry is done? Yeah. So watch for that too, because sometimes they won't tell you. You have to look at it, and understand what's happened. So if no investment account, acquisition entry is not done. Okay? So that's just little things. Now, another thing. What if I just gave you this little working paper and said, how much did A pay? What was the consideration given up? And I don't tell you anything else. Well, the investment in B Corp is 95, so that must be what they gave up. Okay? For now, because if that only works if this is measured at cost. I'm going to put it down. If you're already confused and it's just throwing you off, just ignore it for now. So I'm just going to put a little star here and say, if recorded at the investment account equals consideration up. Okay, but again, you guys, this chapter and all the other chapters, each little part seems simple, but when you try and put them all together, that's where people find they run into problems. Okay, so make sure you stay current. Don't just look at the solutions, oh yeah, that's how they did it. It's trickier than it looks. Okay, every year I have students going, but it seems so easy. And you know they don't do well. So just practice and talk to yourself while you're doing this so you understand. So when we next add on the next step, you're not still going, okay, just wait. We do it on B? No, we don't, just wait. You know, so you've got the pieces. Okay, that's my little lecture for today. Okay, so we talked about some weird stuff here. Now let's finish off our consolidated balance sheet. So we've got A plus B, they're both assets, so we add them, and do we add or subtract the 21,000? Add because it's a debit, so it's going to be 312,000. Now, what do we notice about investment in B Corp? Debit and credit, so it's 0. Always, always, always 0, because when you're consolidating, you move them to You can't have an investment in yourself. Okay? Acquisition differential will always cancel each other out. So, always. But once we move to another method, an easier one, that doesn't take up so much meticulous math, this can cease to exist. Okay? This is the critical one. Put a star beside it. You're going to need it all the way to the final. Okay, the contract is a nice 78,000, and that works to 327. As hopefully we got. So under liabilities, we've got 120 and 30, and do we add or subtract this? Subtract it because it's a debit. These are both credits. So 149. Common shares. Now, here they've separated A's and B's down here. Sometimes they move them together. Okay? So just watch for that. These are just by themselves, so 100,000, 100,000, and 78,000, 78,000. So this is just A. Just A. Because if we merge them together and consolidate them, can we have company B earnings and shares? No, so we have to get rid of them. Credit 25, debit of 25 gives us 0, and same with the retained earnings. So essentially you are always crossing off the subs shareholders' equity, so both pieces, and you're crossing off the investment. Okay? So, you just posted our 2 elimination consolidation entries in and added, subtracted across using the debits and credits, and hopefully it all balances at the end. Okay. Now, related to example 4. Oh, one thing I suggest you guys with these consolidation questions, especially when we do a whole bunch in a row through it, is before you get started working on any assignment questions or problems, the suggested problems, make sure you can do this. I suggest if you have any questions, like you got a little stuck here or there, print off blank ones or do it on paper if you want, but make sure you're not looking at the solution. It is too easy to look at this and go, oh yeah, that's what I was supposed to do. You should be able to do this cold and explain it to someone. So if you've got a study partner in this course, which is a really good idea, especially for these last few chapters, just explain it to them. That's why I really, really love students to use that discussion board. I know it seems funny. Just put, I'm just not getting this. How do you get these elimination entries? Why do you have them? And let someone else explain it to you. And I encourage you guys that it's making sense to try explaining it to someone, because that, when it sticks in your head, and I'm talking long term, right? You're going to need this in the CPA. So, and you're going to be busy relearning all the stuff you learned in 315, 316 right at the start, plus audit, plus tax. Core 1, those are the 3 things: financial, audit, and tax. So you're really going to need this to be stuck in your head. So if you can do it now, you might as well get it out of the way. Okay, that's my little plug for the discussion board. Or meet up on there, or even put on the discussion board. Does anyone want a study buddy or whatever? I don't know what you guys call it now. I don't think we called it anything, but that was 100 years ago. So anyway, okay, I'll stop blabbing. So example 4, purchased shares of company B from the shareholders, and therefore we had to do consolidated statement. We control them, we just don't have their assets. But we need to show our investors, hey you guys, we actually control another company. It's just like we own them. So that's why we combine them. So our shareholders see this because we control this. so we can influence the decisions they make. So it's essentially like it is part of us. Okay? Okay, let's do example 5, control through purchase of shares with shares. So this time, the company is going to issue a tender offer again to the shareholders, but they don't give them money. They're giving them 4,000 of their own common shares. So these are A's common shares. And they've got a market value of $23.75 per share. And there are no direct costs involved. How will the individual statements and the consolidated financial statements be different? So now we've got to think through all the pieces. So A's individual books. Okay, did we have to pay money? No, how did we pay? We issued shares. So our assets, particularly cash, would increase by the $95,000 we paid last time, and increase by the $2,000 because there were no direct costs involved. Now, is the investment in B, so we're looking here, invest in B, is it the same? Is it still $95,000? Yeah, because we already knew from example 4, 23.75 times 4,000 is 95,000. So same at 95,000. Now again, how did we pay? Because here's our little statement thing. How did we pay? Well, cash didn't go down. A's common shares, we issued new common shares and gave them to all the little shareholders of B. So common shares increased by 95,000. And A's retained earnings went up by 2,000. Okay, how about company B's books and statements? Because the statements lead to the books. So what exactly happened again? A gave a bunch of shares, wrote out a nice bunch of shares, had the little piece ready to hand. Who did they hand them to? The shareholders of B or B company? The shareholders. Still only to shareholders. So no change. No entry, in fact. So, now, this one's kind of an easy part. Well, if this is how A's individual books changed, and this is how B's, how is the consolidated statement going to change? Well, it will change exactly like the same way, right? Same changes as A. Based on the same changes as A. So assets are going to go up 97,000. Investment in B, is that going to change? What is it up here in consolidated? 0. So it's the same at 0 always on consolidated. Consolidated common shares will be how much? They're going to increase by 95. And consolidated retained earnings is going to increase by 2,000. right? So no difference. Okay. Now, page 8, which I have lost. Issues, and then a little bit you've got to read on your own. I'm going to start the next video.